Hi, with the football season an increasingly distant memory, I'm really missing my footy. So why not distract myself with another look at my fantasy investment football team? As I've said before, investing is a bit like running a football team. How you position your players on the pitch is really important. My suggestion for a winning investment team has been a 5-3-2 formation with players drawn from around the world. Up front with two British forwards representing investments in UK shares. These could be funds, one investing in smaller companies and one investing in larger companies. Backing them in midfield, I have three skillful players from Europe, the US and Asia, representing shares in the best companies from those regions. Each one of those could be a separate fund as well. At the back, our defence is a motley crew of bonds, gold and commodities. And in goal, good old cash. So how have we done so far in 2013? Well, it looks like this year is shaping up to be another of those games of two halves. Yet beneath those familiar words lies a darker truth. As I survey my team and ponder my next move in the transfer season, I am troubled. It's not that stock markets soared for 4 months and then fell back in May that's the problem. Stock markets do that kind of thing all the time. The problem is that stock markets have rallied because central banks have force-fed money into the financial system, and that has distorted and overinflated markets, so it's hard to know what to do next. The Bank of England and the US Federal Reserve have been doing this quantitative easing for some time. In April, Japan joined the party as the Bank of Japan took its cue from Prime Minister Shinzo Abe and announced it would keep creating new money and use it to buy Japanese government bonds until inflation hit 2%. Japan had rallied hard in anticipation of the move. It carried on rising as investors expressed their delight at the prospect of Japan escaping the deflationary slump that has gripped its economy for 20 years. But the mood soured in May when Ben Bernanke, chairman of the US Federal Reserve, revealed he was starting to think about when to start scaling back the huge amount of stimulus the central bank provides the US stock market and economy. The Fed currently creates $85 billion of new money every month. That's £54 billion, and it uses it to buy mortgage and government bonds as a way of getting that money into the economy and keeping down long-term interest rates. What Bernanke said was uncontroversial. He simply said that if the US economy did well, he would do less QE. If it did badly, he would do more. But that was enough to freak out stock markets, which have got used to lots of free money sloshing around, driving up asset prices. Since then, bonds and shares across the world have tumbled, particularly in emerging markets, but also in Japan, the US and the UK. Markets are worried about how they will cope without the support of QE and the prospect of higher interest rates, which are expected to rise in the next year or two. So how are my team placed? Well, I'm really worried about my defence. US and UK government bonds are overpriced as a result of all the QE purchases. That means my main defenders are old, fat and paid too much money. I'm not going to get a decent return out of them, and they're unfit for the testing conditions that lie ahead. That's higher interest rates and inflation, which bonds hate. The trouble is the bubble in developed market government bonds has infected other bonds as well. Corporate bonds, high-yield corporate bonds, emerging market bonds and index-linked bonds, which provide defence against inflation, are just not as sharp as they used to be. I'm going to need the help of a really good strategic bond fund run by a manager who can shift in and out of the markets at the right time. I've also got a problem with gold. Gold was a brilliant player for me from 2000 until late 2011, but since then he struggled and he picked up a nasty injury in April, which means he's going to be limping for some time. But I'm not going to park him on the bench because I think he could be a useful player in future if inflation becomes a problem. What about my forwards? That's tricky. Shares are clearly better value than bonds, but that's not saying much. It's hard to know when my forwards and midfielders from different regions will do well though. I think I'm right to emphasise the UK within my forwards. That's my home market, and investing in it gives me links to businesses around the world without any of the currency risk of investing overseas. At the moment, the US looks expensive after such a big rise, but then its growth prospects are quite good. Emerging markets and Asia Pacific are struggling in the face of the US resurgence and over fears of the slowdown in China. Longer term, they're likely to grow faster than the West though. Europe is mired in recession, but looks cheap, so looks good for the long term too. To sum up, I'm sticking with my formation, though I may switch one or two funds or players during the summer. It's uncomfortable when shares and bonds fall at the same time, but I'm encouraged by the fact that the best funds, which run a balance of different asset classes, have held up well recently. The second half of the year may well be rockier than the first, but if you've got your asset allocation and team formation right, you should be able to cope with whatever markets throw at you.